All right, we're at the top of the hour. I just want to welcome everyone to a very exciting session that we have here today. Individual and estate tax planning update, navigating the sunset of TCJA provisions in 2025. In this presentation, we're going to cover everything from the provisions that are likely to be impacted along with some of the planning ideas. So very happy everyone could join today. So we'll get started here. If you flip the slide, we've got a few housekeeping items just to go over. So conferences.io. So anyone interested in CPE, well, that might be important to. Please note that you've got the link there that you can click, and there'll be a series of code words that you'll need to enter in order to verify your participation in the webinar. So you'll be able to get the CPE. I will mention also that there's a guide within the platform of the webinar here in the materials section. So if you go to the upper right of the window, you'll kind of see a little piece of paper with a paper clip. You'll see that there's a guide there as well. And so if interested, you can click and open that and they'll provide a little bit more guidance. There is a QR code in the upper right-hand part of the presentation also, so you can pull out your cell phone. Maybe I'll give folks 30 seconds or so to pull out their cell phone and also scan the QR code. That might be the easiest way if you've got your smartphone handy to take you right where you need to go with the conferences.io site. So I'll wait a few more seconds here while everyone kind of gets that settled, because I know CPE, especially this time of the year, is really important. So give it a minute here. If anyone has any issues, feel free to reach out in the chat and we'll try to address those. Next slide, let's go. Here is the promised code word, or excuse me, the code number, 177. So I'll give folks 30 seconds here or so to ensure that they've got the platform up and enter in that number there, 177, to again verify participation in the webinar. And I think even in our chat, we could, if anyone happens to miss those, there we go. So we also just posted the number in the chat should anyone either come late to the webinar or happen to miss it while they were setting it up right now. So I'll head to the next slide here. And here's our, got to put this in here as CYA, legal, every presentation we do. So there you go, there's our disclaimer. So today's agenda. So we kind of compacted this into 5 lines, but there's going to be a lot here with respect to individual income tax and estate tax and the TCJA. So we're just going to start with a quick overview, just kind of level set everybody. What is the TCJA? And then we're going to go into the key individual tax provisions impacted, at the end of 2017 and in effect 1/1 of 2018. And then we're going to cover some planning opportunities. So we're going to take kind of what we learn in what individual provisions have been impacted and kind of tell everybody how can this be impactful to you? What are things that you can do now or in the future to help with your tax situation with respect to some of the upcoming changes? And then we're going to turn it over to John. So Laura and I will cover the first 3 there, and then we're going to turn it over to John, and he's going to cover the estate tax exemption cliff and what we're going to do about it. That's one of the larger impactful things that we're going to want to cover today, and then go over some examples with respect to case studies and how we've helped clients and more so example-based, application-based ideas of what you can do. So that's going to be today's agenda. We will pack this into 60 minutes, and then there's the good-looking crew here of presenters, and I don't mean myself. Laura and John, happy to have you guys with us today. I myself personally have been public accounting for 15 years, done private client my whole career, specialized in individual income tax. Laura Culp's been doing this for over 30 years, former partner of the firm and now tax director. And then John Lowe leads our estate, gift, trust, and charitable practice here, and has really been integral in communicating not only what we're going to talk about today, but just estate planning in general to our clients has been integral in getting that and furthering that practice for us here at Sikich. So happy and privileged to present with these two today. Let's start with a poll question. I actually really like starting with poll questions because I think, again, it level sets the group in terms of our audience and also may or may not change in how we want to emphasize things in our slides. So if we could actually launch that poll question here. And again, you're going to want to answer these if you want CPE. So poll question, how likely are you or your clients going to be impacted by the expiration of TCJA? Say that 5 times fast. So 4 answers, a lot, need to do more planning now. Next answer is somewhat, it's on the radar. Third answer, not at all, that you think now. And then fourth answer, what is the TCJA? And good thing we're going to cover exactly that, I think, on the next slide. So I'll give folks just another minute or two to answer the question here. In the interim, Laura, as people are answering, I guess as you read this question and you look at your client base and some of the clients you served over the years, how do you view the answers to this question? Do you think most of your clients are going to need planning now, or something that you're going to want to look at in the future for them?
I would say we're doing planning right now, as a matter of fact. And both, I'm a wealth advisor as well as a tax director. And so from both tax and wealth, we're looking at the sunsetting impacts. We've got tax planning software that we can use and financial planning software we can use. So yes, I would say we're doing that planning right now, multi-year planning right now.
We always say year-end planning, but we all know it's year-round planning no matter what's going on, right, Laura?
Right.
Okay, so the results are in, and maybe not a surprise, but the first 2 options, so need to do more planning now and somewhat it's on the radar, heavy favorites here. So we've got about 36% that are in the bucket of need to do more planning now. We've got about 55% of somewhat it's on the radar, about 2% not at all, and then about 7% in the bucket of what is the TCJA. So I think our presentation is going to speak to all 4 groups, and just heading right into it, and maybe this will be most beneficial to the last group there. So what is the TCJA? So just to do a real quick overview. So this legislation was voted on and approved in 2017. It was effective January 1st of 2018. And one of the reasons why we're talking today, and this has been so prevalent in particular in the CPA market, is a lot of provisions are set to expire at the end of 2025, right? And so now is just the perfect time really to analyze what those are and how they could be impactful. The TCJA, or Tax Cuts and Jobs Act, more formally known, of 2017 is often referred to as the Trump tax cuts, which is a little bit easier to say. It's a little more concise to say. And it was an interesting political climate at the time. I believe that the House, the Senate, and the presidency were all controlled by Republicans. So it was sort of one of the top things that the Trump presidency and his related staff had decided to make one of their priorities, because they knew they could push it through. And so that's why there were such sweeping tax reform due to the control of all 3 of those items that I mentioned. And so, yeah, I mean, look, the third point I think is definitely true. So I wasn't born in 1986, but I read about it. Okay, I know in 1986 it was an incredible reform. I know, don't shake your head, John. It was an incredible reform. It was similar to where the volume of changes. And so when we were learning about this, the Trump tax cuts, and the immense amount of changes and provisions that were putting forth, it reminded a lot of folks that I worked with of 1986. And what that does is it puts everyone on a level playing field in terms of learning. So we did a lot of learning when these were introduced. And now we're going to have to do a lot of learning and then backing out and what we can do about it now. And so the last thing I'll mention too, and this is something John will cover, is one of the bigger items is the estate tax exemption. The increase was immense, and the subsequent decrease set at the end of 2025 is also set to be immense. So really happy that John's here with us today to discuss what that means for everybody. So I'll cover the next couple of slides. I'll cover will be the key individual provisions that I mentioned on the previous slide, and then again, Laura will cover some of the planning ideas around those. So these are sort of all of them, most of them bucketed into a list here on a slide. So I'm not going to read through these one by one, but what we'll do on the next couple of slides, we'll actually explain the difference. So pre TCJA and then TCJA, what the differences are. And so there they all are listed there. So again, it's not one or two provisions. I mean, there were quite a few, and these are very impactful. So these will be summarized in the upcoming slides here. So if we look here, tax rates. Tax rates, the buckets of the number of tax rates is still 7 buckets, right? So if you count them up there, it's just a matter of what the highest rates are and where those tax rates are hitting in terms of how much income that you're earning. Okay. And I thought we had a slide here that had a nice, maybe I'm missing it, but we'll have to get that out. There was a slide here that had a graph that better explained this, but maybe we can put that in our final slides. But basically what you'll see here is the top rate was 39.6%. Post TCJA, so that's what the expiration is going to bring us to. And then within the 2018 to 25 range, which is where the trunk tax cuts hit, you've got a lower top tax rate, and then you've got the other rates that follow, but they actually impact lower income thresholds. Meaning, long story short, post TCJA, tax rates are going to go up. They're going to go up not only at the top rate, but where they fall within the income tax brackets. So that's a real key provision that's going to affect most everybody. Standard deduction, which I'm sure a lot of you on this call are familiar with, was almost 30,000 projected in 2024, and then after the changes, it's going to drop back down to 16,000. What does this mean? It means a lot more folks are going to itemize, right? And there are actually a few provisions here that affect itemized deductions, which will further show that probably more people are going to itemize in the future. So for those folks that maybe weren't keeping those charitable contribution receipts or medical expenses, those types of things that are traditionally itemized, I would start keeping track of those again, just because you may end up itemizing in the future based on the lower standard deduction. Personal exemptions are back, so they went away, and now they're set to be at 5,300 projected for married filing jointly for 2026. Changes to the child tax credit. It was a nice bonus for a lot of us when we had, especially those of us with kids. I have 3 myself, so $2,000 per child with a much higher AGI limit. That's set to go back to $1,000 per child with a much lower AGI limit, presumably phasing out more taxpayers to receive that benefit. Charitable contributions, not a huge change here. I guess it just depends on your personal tax situation. Those who are fairly charitable, this may impact you more, right? 60% of adjusted gross income limit for cash, meaning that any year you have your adjusted gross income is higher. You have more flexibility in the amount of contributions that you can make before you are phased out and have to carry over for 5 years that cash contribution limit. So it goes down slightly. I don't anticipate that being a huge impact, but it's something we wanted to mention. Mortgage interest deduction. So traditionally, pre-TCJA, you had $1 million that were, and I'll just provide an example, $1 million of indebtedness that you had to which you could take a full mortgage interest deduction. So if you went out and bought a home and you took out $1 million loan and you had mortgage interest associated with that loan, you could deduct the entire mortgage interest amount. In addition to that, there was a HELOC, home equity line of credit, up to $100,000. You could also deduct the home mortgage interest on as an itemized deduction. Under the TCJA, that was reduced to $750,000. So if your loan at $1 million, which is over the 750, you'd have to start reducing the amount of deductible interest. It was capped. And then also that extra $100,000 that I mentioned went away. So that'll provide some additional deduction. Going back to my previous comment about those potentially itemizing more, this here could be impactful to some taxpayers. All right. A few more here. This is a big one, SALT cap. So state and local tax deduction, that on Schedule A itemized deductions, that was limited to $10,000. That means if you're in a high income tax state and you're paying property taxes, you're very likely would have been limited to the $10,000 deduction. It was quite impactful for a lot of people. So after 2025, that now has been, it's going to go back to its repeal, going back to no limit, meaning that we're as tax preparers going to have to keep better track of that state and local tax deduction and the related real estate tax payments that are fully deductible on Schedule A now. It's going to increase for some taxpayers quite heavily, that deduction on Schedule A. Miscellaneous itemized deductions, so tax prep fees, advisor fees, safe deposit box fees, those are all coming back. So that'll be additional deductions that folks didn't the last several years have not been able to take. We need to start tracking those again. P's limitation, that went away. That's considered the other way to folks describe it is calling it a 3% haircut. So based on your income level, if you're over a certain level of income, the P's limitation started to shave off 3% that you were over that income limit to shave down up to a maximum of 80% of your itemized deductions. So it could have been that your itemized deductions were very high, but your income level is also very high, and so your itemized deductions were limited. And so that's actually going to be a big change for some of our taxpayers. Alternative minimum tax. I'm not going to get into the super duper details of this. Just know that it's an additional tax above and beyond the regular tax, and that certain preferences and adjustments are calculated on a yearly basis. That could, in turn, increase an individual's income tax level. And so under the TCJA, the exemptions were increased, the phase-out threshold were increased, there was no 2% miscellaneous itemized deduction, the SALT cap was $10,000, meaning a lot less people were in AMT. I barely saw anybody subject to the alternative minimum tax. Now with some of these itemized deductions back, which are a preference in the calculation, and the reduced exemptions and the phase-out threshold being reduced at the end of 2025, that's going to leave us with a lot more planning to do around AMT. It's going to leave a lot more taxpayers subject to it, and Laura will get into some of the planning ideas that we have there. 199A, 20% deduction based on QBI, which is very impactful for business owners. That's also something that is going to be repealed at the end of 2025. This is going to take some planning. I mean, those who've gotten used to having this 20% shave of income off of their income tax return, and saving the tax that way, basically bringing their effective income tax rate down 9, maybe 10%, that's something that we're going to have to look at again, and they're going to be subject to the full tax on their full income. State and gift, I mentioned, John will cover that in more detail. Don't think I need to spend any more time on that. So those are the main ones that we're going to be that we are going to talk about today in our planning, and then also just wanted to make the group aware of some of these major changes and kind of what they were, what they are, and what they're going to be in the future. And then as we head on here, so we've got another code, 792. So I will, again, if you're interested in CPE, I'll just wait a minute or two here and let those folks type in the number. and then I will hand it off to Laura. So let's just give it another second or two. And for those that maybe stepped away or missed it, it's in the chat. So with that, I'm going to flip it over to Laura, who's going to cover some planning opportunities around some of the provisions that I just had spoke on. So Laura, take it away.
Okay, thanks, Dan. Good morning, everybody. So you can tell that there's a lot of changes coming, and it's very important to understand how the rates will affect you. For example, not only are the rates increasing, but the brackets are more compressed. So for a couple with income of 300,000, they'll see the rate go from 24% to 33%. So that's why planning is so important. Part of that planning is figuring out the timing of income and expenses, accelerating income into years with lower rates and delaying expenses into years with higher rates. For example, income that can be accelerated would be things like annuities, IRA distributions. Small business owners might be able to accelerate income. You can also delay expenses like depreciation deductions. Cash basis taxpayers can try to collect income in advance or delay, again, paying for expenses for Schedule C and rental properties. So you can see there's a lot of opportunities there. As Dan mentioned, the standard deduction is going to decrease. We've been having people look at bunching charitable contributions during this period of time where we had the higher standard deduction. We will continue to look at timing of itemized deductions. So you might want to delay things like estimated tax payments, paying for accounting fees, which are miscellaneous itemized deductions, as Dan mentioned. Also, employee business expenses have not been deductible. Currently, they will be again in 2026. So with that, we're going to go to the next slide, which Dan mentioned, the P's limitation. And high income taxpayers have their personal exemptions as well as their itemized deductions phased out as they hit these different income limits. And you can see that for married filing joint, it is 395,000. So for high net income taxpayers, that adds about 1.2% tax. So there, we would strategize on when to itemize versus taking the standard deduction based on expected income post 2025, which again could impact the timing of your itemized deductible expenses. So next slide. While capital gain rates are not changing per se, at least under the sunsetting, they may change with change in administration. Capital gain rates are based on brackets, and so it's important every year actually to look at your capital gains. And if we think rates are going to go up, harvest capital gains before the rates go up, harvest capital losses after the rates go up, considering wash sale rules. Wash sale rules are when you sell a security at a loss, you can't reinvest in it for 30 days or that loss gets deferred. And then one provision of the TCJA was opportunity zone investments. Why some of the provisions of opportunity zones, some of the tax benefits are no longer available. One that is still available is that you can defer capital gains for 2024 and 2025 until 2026 by investing the gain into qualified opportunity zone funds, or QOF. If you hold the fund for 10 years or more, then the basis in that fund is increased to fair market value at the date that you sell the fund and that you don't pay any gain. So that could be a real benefit if you invested in something that you thought really was going to appreciate significantly over 10 years. Dan mentioned the AMT, and the exemption is going to decrease for married filing joint from 133,000 to 110, but more importantly, the phase out of that exemption is going to drop from income of 1.2 million to 210 for married filing joint. So basically, a married couple with income over 320,000 will most likely be subject to AMT, and the AMT tax rate is basically 28%. And as I think Dan might have mentioned, but Unfortunately, things like states and local taxes and miscellaneous itemized deductions are not deductible for AMT. So again, more people are going to be subject to AMT. The change in AMT is projected to increase taxes for more than 1/5 of taxpayers in the 200 to 500,000 income range, and 70% of taxpayers with income between 500 and $1 million. So one thing that we did a lot pre 2018 was look at the timing of state and local taxes and real estate taxes, not just for itemized deduction purposes, but also alternative tax purposes. So we'll be doing that again. Next slide. Dan mentioned the AGI limits changing for charitable contributions. Again, if you're going to consider taking the standard deduction for 2025 because it's higher, you would want to push charitable contributions into 2026 possibly. Again, what I called bunching of charitable contribution, bunching them in 1 year to get a bigger bang for your buck, so to speak. Also, like charities love cash, who doesn't? Donating appreciated stocks can be a very tax efficient charitable contribution. You get a deduction at fair market value of the securities. You could take that cash you're going to donate and reinvest in that same security and get a higher basis, so you avoid the gain. Donor advised funds are also great charitable giving techniques. Vanguard, Fidelity, Schwab all have donor advised funds, as well as your local community foundation. Again, you donate the appreciated security, get the deduction the year that you donate it. And the beauty of donor advised fund is you don't have to distribute the money out right away. You can do it over time. So you could donate, 5 years of donations in 1 year, and then distribute them out to the charities over the next 5 years if you wanted to do so. And then for those taxpayers that are 70 and a half or older, a really very tax efficient charitable contribution is using your IRA for qualified charitable distributions, QCDs. You can contribute a maximum of up to $100,000 per year. It can be your required minimum distribution amount. So the QCD is excluded from federal adjusted gross income, which is helpful for Medicare purposes. It also obviously keeps you in a lower tax bracket. And also some states use your adjusted gross income for state tax purposes, like Ohio, for example, where I'm located. So you can avoid state tax as well. Next slide. I love Roth IRAs. I always encourage people to make Roth IRA contributions. But one tax planning that we're doing right now, particularly in the wealth area, is looking at Roth conversions. The idea in general is to use the current marginal rate for the conversion so that you stay. So if you're in the 24% bracket for 2024, you go up to the limit and make a conversion into that amount. But it might make sense in some cases to go into a higher bracket. A good fact pattern for Roth conversions is where you expect the converted amount to grow significantly. You expect your current marginal rate is probably lower than the rate that you would be taxed at when you are required to take distribution. You've got cash available outside of the IRAs to pay the taxes. You don't need the IRA funds for living expenses, and you expect to owe estate taxes because the taxes that you pay on the Roth conversions come out of your estate also. And the reason I love Roth IRAs is right there. They grow tax-free. So it's a great way to have an asset grow tax-free. You don't have to do required minimum distributions. And while your heirs, your Roth IRA will be included in your estate, they will not be taxed on the distribution for income tax purposes. Next slide. So again, talking about Roth IRAs, a number of taxpayers are not eligible for Roth IRAs due to the adjusted gross income limits, which are $146,000 for single and $230,000 for married filing joint. So we do what we call a backdoor Roth IRA, and that's where you contribute to a non-deductible IRA, wait a bit, convert that non-deductible to a Roth IRA, excuse me, and on conversion, you're only taxed on the earnings in that non-deductible IRA. So assuming that you converted pretty quick, there'd be very little income taxed. There are some limitations if you have other IRA accounts, other taxable IRA accounts. The conversion would not be fully, would be partially taxed. And then another great planning that I think we all Sikich tax people encourage their clients to do is fund Roth IRAs for their children and grandchildren. Again, those grow tax free, can get them started making investing in retirement and learning about the stock market at an early age, but they are limited to earned income. And they also have the same AGI limit I mentioned. And then finally, next slide, 529s. Now, 529s are not being impacted by the sunsetting provisions, but again, funds can grow tax-free as long as they're used for education. And it's a gift you can give your children, your grandchildren, and future heirs because you can leave money in 529s indefinitely. So as you can see here, it can be used not only for higher education, but also for K through 12. It can be used to pay off a limited amount of student loan debt. And under Secure Act Point 2, you can contribute the unused 529 plans to Roth IRAs for the beneficiaries. There are some limitations, as you can see here. But if you have young children, young grandchildren, I encourage you to set up 529s for them. It's a really great gift and also wonderful that the funds can grow tax free. So with that, I'm going to turn it over to John and he'll talk about estate taxes. Oh, we've got a poll question though. Sorry, poll question first. So if you pull up the poll question, please. Okay, which TCJA provision is most likely to impact you or your clients upon expiration? Tax brackets, various itemized deductions, alternative minimum tax, Section 199A, or the sunset of the estate exemption. And Dan, would you like to chime in what you think is most important here?
Yeah. And I might fall in line actually with how the votes are coming in. Certainly the brackets are going to be top of mind for everybody, which is why I would probably consider that the most impactful just because of the broad spectrum of taxpayers it's going to affect. But I also would say 199A, I think that's something that 20% qualified business income deduction for qualifying taxpayers, depending on some of the limitations and type of business they're in. I think that's something that those folks have gotten used to being able to take on their income tax returns, and it's sort of going to be a bit sobering when all of a sudden that goes away, and they're going to be subject to higher income tax rate. I think that's going to impact a lot of people, including small business owners.
Absolutely, I agree. I mean, basically going from a 29.6 rate to maybe a 39.6 rate, it's a
Yep,
pretty big
that's right.
increase.
It
So
is.
I agree with you. And basically, almost everybody will have a tax increase, except if you have very low income with the tax brackets. So with that, we'll turn it over to John.
Thank you, Laura. Good morning, everybody. So I'm John Lowe. I do work exclusively in the estate and gift tax area, trust and charitable planning. I come to this role at Sikich after maybe 20 years as an actual estate planning attorney, and then now 11 years in public accounting. I oversee a lot of our gift and estate tax preparation and filing, so I have a good deal of experience with the techniques that are catching the attention of the IRS and how we respond to them and plan ahead of time for them. I'm working right now, obviously, with the sunset looming, with just dozens and dozens of clients who are trying to be strategic and make informed decisions on transferring their wealth. Dan, next slide, please. And so what I'm going to do real quickly is just talk about where we are, where we're headed, and then three groups of folks that fall into different strata with respect to the estate tax sunset. So let's jump forward, Dan, please. Where we are. We are actually in a historically favorable estate tax setting, gift and estate tax setting. The exemption at 13.6 million is the highest it's ever been. It's slated to increase next year to an even higher number. And when judged against past estate tax regimes and gift tax regimes, our current estate tax rate is 40%. That's the lowest it's been in some time. That's not an easy number. So for high wealth clients who have estates over the estate exemption, every dollar after that is subject to 40%. Due and payable within 9 months of death in most situations. So the estate tax is an onerous issue, and we really want to try to plan for it. Note that in addition to the federal limit, there are states who have their own individual estate tax rates. Illinois has a 4 million. Minnesota, I believe, is 3 million. So we have to plan for that as well. Where we are, there seems to be, and now we turn to kind of a combination of where we are and where we're headed. There seems to be no consensus belief that we will move away from the drop in the estate tax. All I read, all I listen to, the leading experts across the country believe that this is unlikely to change and that we will have a drop in the estate tax. Of course, the election could impact this greatly, but even then, I think that there's a difference. Back in 2012, we had the drop of 5 million to 1 million was the plan. And on the last day, or actually after the deadline, they kept the estate tax at 5 million and didn't drop it. So some people are saying, didn't we go to an awful lot of planning and problem in 2012 when in fact it didn't happen? Is it going to happen again in 2026? In 2012, it was going to drop to 1 million. That would have ensnared a great number of Americans. In 2026, it's slated to drop to 7 million or so. That will not ensnare as many Americans. So we really are dealing with the 99th percentile of wealthy individuals. So I don't see that as a super high priority to save taxes for the ultra wealthy. So I'm of the personal opinion that we're going to see this change. And so we are already acting pretty actively to plan for it. So what is the 2026 sunset? Dan, if you could go forward, please. This chart has a lot on it. The left column is the year, and the second left column is the estate tax exemption. You can see that over time, the estate tax exemption has been increasing. And in 2018, it doubled. So we moved from 5.5 to over 11, and it's continued on its inflationary adjusted pace to 13.6. It'll adjust again in 2025 and then drop in 2026. The estate tax rate is that flat 40% as it stands now. And the gift tax exemption, the second to the right column, is slated to lockstep with the estate tax exemption. Somewhat complicating is the understanding of how the estate and the gift tax work in unison. You can choose to use your $13.6 million during lifetime and give it away, in which case you would be using your gift tax exemption. You can also wait until your death to leave your $13.6 million to your heirs, in which case you would be using your estate tax exemption. To use one uses the other. So if you use it during your lifetime, you do not have an additional 13.6 at death under the estate tax. This is the issue that's causing a lot of people concern, right? The drop from a married couple of nearly 27 million next year, slated to be maybe 28 million, to a protective number for a married couple of only 14. And so that's where we are. Next page, please. So I kind of, the first strata is the majority of America, and government data suggests that this strata, estates under the estate tax exemption, married couples under, I kind of put a range of 10 to 12 million, single individuals under 7 million. Government data suggests this is 98 to 99% of America So most of us are not going to be impacted by the sunset of the estate tax exemption. We have very little concerns for estates of 10 to 12 for married couples, especially low growth estates. But I think every sweeping statement I make is subject to an exception. And the exceptions are high growth estates. So you might be a $7 million couple today, but you're both high earners and you are accumulating wealth quickly, or you have a great investment that has been returning unbelievable returns for you, or you might be inheriting assets, in which case you have to factor in the wealth that you'll accumulate by inheritance as well. So you might be under the estate tax exemption today. Keep in mind that you could change very quickly. And the bottom point is an important one. Just keep aware of where you are. We do a project here, or we do a service here at Sikich. It's an estate illustrator, and we kind of take into account all that we know and all that we expect might change. And we say, hey, where are you today? Where would you be in 2026? How does your estate plan impact it? And when we have informed decisions, then we can make really good decisions. The thing that I want to talk about for the majority of America is whether or not you have an estate tax concern, you have an estate planning concern. And I read a title in a New York Times article that said an intergenerational tsunami of wealth is occurring. Baby boomers born between 1946 and 1964 are estimated to hold approximately half of America's $140 trillion of wealth, 65 trillion of which is to pass to heirs, and 10 trillion of which is to pass to charity. So we have unbelievable amounts of money that will be moving, whether or not the estate tax impacts it. So to each and every one of us on the call, a good estate plan matters. And to the 40% of you or the 50% of you that has an estate plan, congrats. The stats show that some 50 to 60% of America does not have an estate plan. So there's no one thing that nudges you forward. It's not going to be the estate tax for the majority of America, but getting an estate plan in order is critical. In the absence of an estate plan, most people actually have an estate plan by the way they hold their assets. Married couples hold assets jointly and they pass to the survivor, or they have beneficiary designations that leave assets directly to the survivor. So we are, in a sense, protected if you're a married couple and you have that type of estate plan. That doesn't work as well for second marriages or mixed marriages with different children. Dan, if you would move forward, please. One thing that is a really critical opportunity and a tool that we have at our disposal is what's called the portability election. And the portability election is to say that if a married individual, so this only applies to married individuals, if a married individual dies and didn't use his or her estate tax exemption, they can port it, transport it, give it to their surviving spouse. The surviving spouse would then have not only his or her own estate exemption, but the other one that was unused. That can be critical. So if you are in that $10 to $12 million range and you take the surviving, or you are the surviving spouse and you take the unused exemption of your predeceased spouse, you double your protection. And I like to say that you have a $13 million in today's environment. You have a $13 million free exemption in your back pocket, and you can pull it out anytime you need it. The government has made this quite easy to elect portability. You can elect to grab the portability of a deceased spouse up to 5 years after the death of a spouse. So say that you are in a spot where you just don't feel like it's necessary, and I could put my name on that and say, we're okay not filing an estate tax return today to grab the election. Facts may change, and in a few years, you might have an estate that is north of the estate tax exemption. At that point, you can go back up to 5 years and grab that exemption. To actually elect to get that portability, you have to file an estate tax return. And the estate tax return is no small undertaking. It is a snapshot in time of every asset and every expense of an estate, documented and supported and filed with the IRS. But for those folks who are in that middle ground, not sure if they need to protect some additional wealth, to file that estate tax return, I like to say it's the cheapest insurance policy out there against a 40% potential estate tax. The range of fees to prepare it are wide, but it's several $1,000s. I think we've been quoting for certain estate tax returns some $5,000 to $15,000 depending on complexity. So that's not a small undertaking, but if you're in that scenario, it's probably helpful. The individual factors, we talk a lot, and this is a discussion I have consistently with people where we want to make sure that the portability election is a good one. And so we take into account all of the factors. If an 80-year-old woman whose husband passed away is asking whether or not to take the portability election, and all she has is a portfolio of CDs that are not growing in any way, and she's under the estate tax exemption today and still under $7 million under any scenario, I would not file an estate tax return to get portability. On the other hand, if it was a 50-year-old who died and left a survivor with an estate of $5 million, but a high earner or a portfolio of securities that has been in the market a long time and is doing well, that to me sounds like a case where I would recommend the portability election. Danny, if you want to jump forward. Another means by which folks who are in the majority and they start to get close to the estate tax exemption, gifting. Laura touched on it. There are many means of gifting. You can gift to 529 plans. You can gift directly to colleges to pay tuition. The gifting to me is an ultimate weapon, although it has its challenges. And that is that a lot of our clients are reluctant to gift. They are uneasy with the idea of saying, I can't start peeling off money and giving it to people if I'm not sure that I'm comfortable. And that's a challenge. And, mathematically, oftentimes the math is clear that you have enough of an estate that you can begin to gift, but it is a mindset. And elderly clients of mine oftentimes push back on the idea of gifting. And you also have to have, if you want to bring your estate down by gifting, you have to have enough people that you want to give to. And, for families that don't have a lot of heirs or children, it is somewhat difficult to come up with enough to gift. But done right, gifting up to $18,000 per year per recipient per donor. So a married couple can give $36,000 to each of their, let's say, 3 children. What is that? That's $100 and some $1,000. Gift tax-free, estate tax-free. A common misconception is that if you do receive gifts, you do not have to put that gift received into your income tax return. If your parents give you $36,000 or your grandparents give you $36,000, that's simply money that you put in your bank account and you don't have to report it as income. Next page, please. Kind of given that 98%, 99% of America is in this strata, what do we do? And to me, I just created a average wealthy American, successful American. And this is just somebody who, married couple, I have 2 children, early 20s, a $6 million estate comprised of the typical assets, a house, an investment portfolio, bank accounts, retirement plans totaling $1.5 million between the 2 of them, life insurance on each spouse of $500,000, with only $200,000 of cash surrender value. Inheritances. What would I do in this situation? I would have a good estate plan, right? I would get really good documents in place, probably a revocable trust or a revocable trust that would say, look, if both of us are gone, our children are going to inherit our wealth in some way, and we ought to dictate how they get that. In the absence of an estate plan, each of the two children would, through what's called intestacy, the fact if you don't have an estate plan, the state provides one for you. Intestacy would say that each of these two children, now adult, would receive $3 million at the death of the second of the spouses. To me, that's a worry. I've seen too much for too long where wealth inherited in one fell swoop oftentimes leaves easily. So I'm a proponent of longer duration trusts. Kind of my mind has changed over my 30 plus years of assisting clients where I like longer term trusts, particularly, and my thinking is this: if you trust your children enough to inherit your wealth outright, and that's what many people say, hey, at 25, they get all of my money. If you trust them enough to inherit the money outright, wouldn't you trust them enough to have their own trust, of which they're their own trustee? Because by having assets in a trust for the benefit of a beneficiary, you can protect against creditors. So you can, in a sense, provide a prenup for the wealth that you leave to your children in a trust, because it's protected in the event of a divorce. So to me, I like longer term trusts, and I also like sequenced distributions to children. In this case, what I would say is a key component of this estate plan, I would say, is don't do anything really right now. Don't give away assets you don't need to, and allow your assets that you retain at death to capture what's called an income tax basis adjustment. So that investment portfolio, of which fair market value is $1.5 million and cost basis is $600,000. If you held those assets until the death of one or both, depending on what state you're in, if you held those assets until death and you left those investment assets to the two children, each of them would get $750,000 of stepped up assets, meaning their basis would be equal to what it was worth on the date of death. They could then sell those assets at no capital gain. So to me, that's the key thing that I would talk about, is hold assets until death, and then strategize about how you want to leave that retirement plan to your children, because it's a significant asset. Dan, jump forward, please. Really reiterating everything I've said. You can read that on your own. I think it's just a summary of the planning for the majority. Next one. Yeah. Reiteration yet again. So there we go. Tax planning for the difficult middle. This one, this is what's challenging me these days, are the folks who are in that difficult middle where they understand that they could give away their 13.6 million today. And the IRS has made clear, I didn't read it, but if you give it away today, there is no current, and I don't believe it will ever change, but no ability for the IRS to claw those assets back into your estate. So I do have a lot of clients who are taking advantage of the ability to give 13.6 million away. It's not easy for a family worth $25 million to give away $13.6 million. It's just not. I think that many, or even doubling that and saying, look, we can give away all of our wealth. It's just impractical to think. So what can we do in the middle? And there are some planning opportunities. One, again, is just to continue to gift. I like to gift. And anytime I see somebody slightly over an exemption, or even $1 million over an exemption, I'm not troubled by that. I do think that we can quickly pivot and move assets to the next generation. A couple of other things that we can do. We are going to use portability in the difficult middle. If a spouse dies, we will file an estate tax return. It's just simple math that you would want to do that. Charitable giving, Laura talked about several techniques that any estate tax problem can be solved by being charitable. You have to be charitable, but you can solve your estate tax problem by gifting assets away. Discounted gifting. I like to take assets that are solid, growing assets, closely held businesses, real estate investments, and try to turn them from their full value to less than full value by discounting. And that's to be a minority shareholder or a non-voting unit holder in an LLC. To do those things, we can take estates that might be over the estate tax exemption and drop them to a smaller number. Okay, Dan, next page, please. And we'll skip right through to the next one. There are several techniques you can do. The one that we're seeing the most is what's called a spousal access trust, and maybe some of you have done some reading on it. A spousal access trust, Dan, can you jump forward, please? And one more page, please. Thank you. A spousal access trust is a technique by which one spouse chooses to use his or her exemption. I had a client, successful construction company owner, maybe $25 million total estate. They weren't comfortable using both of their exemptions, but what they did say is, why don't one of us use our full exemption, 13.6, and then the other one will drop down to 7. So we would protect 20 instead of the 14 under the sunset provisions. The husband in this case, because the wife was more likely to live longer, healthier, he created a spousal access trust and put 13.6 million into the trust. It's out of their estate, and all future growth in that asset is out of their estate. They didn't sleep comfortably at night knowing they had given it away. The spousal access trust says yes, but the wife is still a permissible beneficiary. So the assets go across and then can come back if need be. So in a sense, you have the best of both worlds. It's out of your estate for estate tax purposes, but still reachable. Spousal access trusts are not without challenges. If the beneficiary spouse, in this case the wife, if she died a year after establishment, then the husband in this case can't get those funds to come back to him. It's just simply not allowed. So that's a worry. The second is a divorce. In the setting of a divorce, after the spousal access trust is established, we have difficulties. There's bad blood generally, and breaking up a spousal access trust is not an easy thing to do. Dan, if you would jump forward. And I'm going to skip this one in the interest of time. If you're in the difficult middle, and here's a code word, I'll let you enter it while I continue to talk because of the time constrictions. If you're in the difficult middle, understand that to act now is probably in your best interests, but not to overreact. And to know that if you model it and understand it, you're more likely to make a good decision. I think that I haven't addressed by any means every situation, but if you have a situation, find your advisor, talk to them about it, because there are opportunities to do some really sophisticated things. The next page, please, Dan. And then because it is so small of a percentage of America, we'll give it the smallest amount of time because of the looming deadline. For the select few, the estates that are well north of 40 million, these are folks who are already subject to estate tax, and for them, they know that they need to act. Get ahead of this, get with your advisors, because I do think, and Dan and I have talked about this at length, a lot of our appraisers and valuation experts who will give us numbers of gifted assets, they're getting busy, and they're going to even be more busy. Estate planners, we're getting busy. Get ahead of this. For the select few, the techniques that you would use, gift early, use your full exemption, put it into what's called a dynasty trust, or the ability of a trust to last for generations without estate tax. Dan, if you would go forward, please. And we can keep going. But I apologize, we're running a little short on time. We've worked with an awful lot of wealthy families. One in particular is just a great situation. He gave away assets, his and her estate tax exemption, into a trust. The trust will balloon in value shortly when the company that he placed into it goes public. So the value, we put in 25 million about, and it's going to be worth 60 to 70 million in a couple of years. So the ability to do really sophisticated planning is within our reach. And Dan, if you would go forward, please, to the takeaways. So 2 slides forward. To kind of reiterate, estate planning for the majority of America is going to be enough. The sunset won't impact you, but it requires action. And given that 50% of us don't have estate plans, that's what we're facing today. Again, the idea to get with your advisors today if you're in that difficult middle, because the decisions will be hard and they'll take some time to plan for. And Dan, do you want to close it out or should I? Dan, I'm not hearing you.
Can you guys hear me now? Can you hear me, John?
I'm not hearing you, Dan. I'll just finish it. I've got the slide here that says, as a reminder, please complete the survey that pops up after the webinar in order to receive your CPE for those needing it. And then check out from your conferences IO. And then your certificates of attendance will be emailed to you within 2 to 3 days. If you asked a question that wasn't answered, and I did see some chats popping up, and I apologize if we didn't get to them, a member of our team will respond to them. And as we mentioned in the beginning, today's webinar was recorded and will be available for on-demand access. Thank you all for attending and have a great day. I appreciate everybody's time.